specifically. So in other words, the point here is innovation continues. If we're trying to highlight some of the areas, and again, I'm looking through my glasses which focus on technology, there has been certain impact over the last 12 or 18 months. And in severely hit have been consumer, online advertising, the semiconductor industry, enterprise software. Moderately impact has been the telco space, e-commerce, IT, medical devices. There has been substantial reduction in R&D investment by big corporations, which means what? It creates opportunities. Because whilst big corporations are not able to invest in that sort of talent, and they have to lay off, or they have to freeze, or they have to stagger projects, startups have an opportunity to capture that space so that when in 2 or 3 or 4 years, when the financial situation improves, then those corporations are going to reach out and want to acquire those companies that have developed those technologies, because it's going to be through those companies that they'll be able to get market traction quickly. So it creates an opportunity. And of course, there's been decreased VC investments. What do we see today? What's happening? And again, this may be, of course, not news to some of you in the audience, but there is a shortage of capital. Not just for startups, by the way, but also for funds. Because, as I always say, our parents are the financial institutions. Our children are the startups. If we don't get the capital, then we can't give the capital. There's been a decreased number of new startups and new VC funds. Some have said, particularly in the US and the Valley and even in Israel, that there's too many startups, that there have been too many funds. And there may be an argument for that. There's been a much slower investment pace and a much stricter investment criteria. Of course, cash is king, and there are opportunities, and there will be more opportunities going forward. And finally, exits. The IPO in market, as we all know, particularly in the US, has been closed for a long time. Very few, less than 10, I believe, IPOs that have taken place over the last 2 years. Valuations are lower, M&A activity is lower, and therefore it requires venture capitalists or investors, not even venture capitalists, to syndicate investment rounds to ensure that there is enough capital in the companies. We're going to talk about that now. So, what are we doing? What are we focusing on? What are venture capitalists doing? Or even other investors doing who behave like venture capitalists? They're slowing their pace of investments. We're adjusting our investment terms. We're abandoning many non-performers. We're letting them basically die out. We're not refinancing them because we want to keep capital for those companies that we know have much higher potential, number one. And number two, because we want to make investments in companies where there's going to be much lower valuations. So in new investments. So we're abandoning the non-performers. There's a lot of more ongoing support for management teams. There's a lot of support for the portfolio companies. Partners are spending more than 50% of their time with the portfolio companies, with the existing investee companies. And I think very critical, and most importantly, companies have been forced to cut their burn rates, particularly, as I said, startup and early stage companies, to survive, to defer hiring, to cut investment. And this is something which often is talked about when people compare Israel, for example, to the United States, and maybe also to, I think in places like Singapore and China, culturally it's a little bit easier, I believe. Perhaps things have changed so rapidly in China in the last 2 years that if you say to somebody, we're going to cut your salary, he walks out on you. In the US, that can happen. What Israel has been so far successful in is when people realize that a company has to reduce its burn rate and investors come to the company and say that, usually the founders, the CEO, the management team are prepared to accept that. They're prepared to understand that for the long term, they need to cut their burn rate. They need to cut their own salaries. And the teams usually, even the employees are prepared to do that because they know that the long-term goal is what's more important. In the US, we have found many times when many of our portfolio companies migrated to the US and we brought in US management teams, the companies died after 2 years because the salaries were so high, the operating costs were so high, and those individuals were not prepared to cut back. This is very interesting, and I said to the E&Y partner that was here that I'd give a plug to E&Y because E&Y did a very interesting survey just a couple of months ago. It interviewed 25 venture capital funds in China, in Israel, and the United States. They asked them a whole lot of questions, and I've picked out 2 questions which I thought were most relevant to the audience today and to put into my presentation. And it was said, relative to a year ago, have reserves for follow-on investments in your companies increased, decreased, or stayed the same? Well, I think everybody could see the bottom line there, because that is what is happening. That is what is required. And I'll be honest with you, the biggest battle I've had here, when I've been living in Singapore and looking at investments and, in a sense, educating sometimes co-investors about when they're investing, is the fact that you need to keep reserves to follow-on investments. The habit of many venture capital funds in this region, at least in the last 5 years, has been invest one time and then let's see what happens. There is no sort of program set up where we say we're going to invest this amount, we're going to allocate this amount of capital for the company for the first 2 years, we're then going to allocate this amount of capital for the next 2 years, etc., assuming the company meets milestones. It's unheard of. So whenever somebody says to me, are you fully invested? And I said, yes. They said, oh, you've invested your whole fund? I said, no, I've invested 60% of the fund. So they said to me, so you're not fully invested? I said, no, we are fully invested. I said, we leave an allocation of capital. And this has become most critical now, and it's going to become most critical for the next 2 or 3 years. And the second question that was asked by E&Y is, how many months of cash burn are you holding in reserve for your portfolio companies? Why? Obvious. Because the expected exit time frame for IPO and M&A has been pushed out. So you could see when most people, perhaps before, were looking at 12 months, 12 to 18 months and 18 to 24 months has become most critical. And that's exactly what I say to entrepreneurs today. For some reason, there is, again, for those entrepreneurs out there, there is a fear. There is a fear that we can't raise too much capital, because if we raise too much capital, we become diluted. So therefore, let's raise enough capital, and you'll see we'll be break even in 8 months or 12 months. And I say to them, but you know, you've got to expect that it's not going to take you that same amount of time, number one. Number two, so what happens when you're break even? So that's it. So you need to grow the business. So when you have an opportunity to raise capital, raise the capital. Don't be afraid. And any company that I look at, the message is clear. You need to show me that over the next 18 to 24 months, you have enough capital. Otherwise, they're not going to invest in you in the first place. So we need to syndicate around together that's going to give you capital for the next 2 years. So I've mentioned to you what venture capital funds are doing today. So in my opinion, in my humble opinion, what should companies be doing today? And again, this is for what I call portfolio companies. This is for early stage companies at various levels. Companies that may be just pre-revenue or initial revenue. They must maintain a solid financial position. Raise the financing, as I said, whenever is possible. Focus on your competitive advantages. Know your customer and the entire food chain. You know, it often surprises me that I'll sit in front of a company for the first or second time and I'll ask them about their business. I'll ask them about who their customers are, what's the ecosystem, what is the food chain, who their competitors are. And the entrepreneur doesn't seem to know. And I don't think it's because they can't know, it's just for some reason they don't seem to have done all of the homework. They don't seem to realize that it's very important to understand the entire picture. And that's what's so critical for companies in order to progress, not just in terms of, and we'll come to that, not just in terms of what I need to know as an investor, but for yourselves as companies. You've got to know who your customer is, what they need. What are the business models? I have a number of companies that I'm in discussion with today, and the business model is confused. The channels they want to use is confused. Are they doing it through a joint venture? Are they doing it through some other licensing arrangement? Are they doing it through a reseller? Sometimes a company can have 4 different business models, 4 different types of channels. It needs to be refined.